In this fifth short video, we're going to be discussing preferred stock. If a company has one class of stock outstanding, it's always going to be common stock. In many cases, a company will include in their charter an authorization for a second class of stock, and we refer to this stock as preferred stock. Many companies have the option of issuing preferred stock, but they haven't actually issued any. So preferred stock is called that because it has two preferential rights over the common stockholders. One of those is dividends, the second one is assets at liquidation. So we're going to see that a preferential right to dividends means that the preferred shareholders have to receive their dividend before the common stockholders receive any dividends. And as we discussed when we were going over the rights of common stockholders, if there is preferred stock outstanding, they will have a preferential right to assets at liquidation, meaning that if the company is liquidating, they're going to sell off all their assets, they're going to pay off all their liabilities, they're going to reimburse the preferred shareholders for their investment before they pay anything to the common stockholders. In terms of issuing preferred stock and paying dividends on preferred stock, the accounting, the journal entries for those transactions are essentially the same as for common stock. So in terms of this preferential right to dividends, preferred stock has a specified dividend which must be paid annually before the common shareholders receive dividends. So typically, this specified dividend is going to be a percentage of the par value. Preferred stocks typically have larger par values than common shares, so a $100 par value is pretty standard. So if a company has a $100 par, 9% preferred stock, then the annual dividend on that is going to be the $100 par times the 9%, or $9 per share per year. So that is how you compute the preferred dividend. So what happens if that preferred dividend is not paid? Well, first, if the whole preferred dividend is not paid, then common shareholders will not receive anything in that year. In subsequent years, if the company pays dividends, whether the preferred shareholders get the past year dividend or not depends on whether the preferred stock is cumulative or non-cumulative. If it's cumulative, that means that the unpaid dividends on the preferred stock at year end become what we call dividends in arrears. And these dividends in arrears must be paid in addition to the current year dividend before common stockholders can receive dividends. Dividends in arrears is disclosed, but it's not a liability. As we discussed earlier, dividends are not liabilities until they have been declared by the board of directors. If the preferred stock is non-cumulative, essentially any unpaid dividend on preferred stock is lost to the preferred shareholders. It is not going to get paid, or it doesn't have to be paid before the common shareholders receive dividends.